Market breadth is getting pretty bad. We've got more stocks declining than we do advancing in the index, even as it goes on to produce brand new record highs. And historically, this means that the market's got a little bit more upside before typically pulling back or offering consolidation. And it's not just stocks, it's high-yield bonds as well that indicate a similar divergence. But don't worry, the Santa Claus rally typically happens in the second half of December. And Tom Lee, he just released his SPX 7K forecast for the first half of 2025, so we're all set. Oh, and how could I possibly forget? Tesla and Mr. Musk fulfill the prophecy of the stock trading 420.69 as an intraday high. So those data-driven divergences earlier, they don't mean anything, forget about that. Jokes aside, welcome back to the Trade Brigade Midweek Show, where we'll take a look at all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from an overall trend perspective? The trend certainly remains in the upward direction. I would argue that the higher low that was produced on Tuesday was the ideal higher low. Remember that in the trend count, we never really found an hourly downtrend over here. This did not produce an hourly downtrend. We finally had an hourly downtrend on the Monday-Tuesday combination, and the pullback went no further than the previous area of resistance, which we could now start to see is acting as support. Now, of course, we opened higher on today's Wednesday morning session based on the CPI print coming in line with the expectations. But what I find most fascinating about the daily close here is that it's technically above the 2-day low breakdown point that offered the move to the downside on Monday, Tuesday in the first place, which is over 607. And we'll get more granular here on the hourly chart in just a second to see that. But generally walking forward, now that this higher low has been produced over the lower bound of the weekly expected move, above that $600.50 mark, the previous highs that we were just talking about here, resistance, newfound support. Now that we're over that and we've avoided basically a lower high on the daily chart, we've produced an equal high as of today's high of day, up around the all-time high, that's 609. The ideal look going forward is just consolidation here that does not revisit Tuesday's low. Then Brigade bolts into blue sky territory. Up and over 609, we really just have to look for the upper edge of the weekly expected move, which is at 614.12. Now, the bears are probably saying, yeah, but what about the possibility of a double top? You just said in the intro that there are some bearish divergences. Maybe there's a pullback around the corner. Yeah, I mean, that is true to some degree after a little bit of a rally before that. That's what the data would suggest, right? So if this is, let's just play devil's advocate, if this is going to turn into a double top, 1 and 2, what does that mean needs to happen for the double top to trigger, right? We always say this here on the channel. It's not a double top until it is, meaning that you need to break down underneath the neckline, in this case Tuesday's low, and you would need to bring in a lower low to change the trend. So unless $600.50 miraculously fails into the end of the week, which currently, based on the data we're about to walk through, does not look likely, unless that happens, I'm going to remain more so bullish, looking for continuation of blue sky territories, rather than being bearish and saying, no way, the market can't possibly go any higher. No, it certainly can. It looks healthy as of right now from a technical perspective, and once again, that blue sky breakout target is 614.12 coming from the upper edge of the weekly expected move. So a pretty straightforward daily time frame chart, looking for consolidation here to continue. Brigade bolts to blue sky territories. If we pull back, giving it the benefit of the doubt, ideally it would look like something like, along these lines to recover. And then we will have to change our tone slightly. I'm not even going to use a red crayon for this, but some sort of breakdown that happens in here, I wouldn't say it's the end of the world. And the reason I say it's not the end of the world is simply because we know that the trend was lows, higher lows. This is the next higher low. There's quite a bit of distance between those. I would still be okay. It wouldn't be great, but I would still be okay with a daily higher low forming somewhere here around 595.25. So even if this does turn into that double top we were just alluding to, something like this, I would still be looking for pullback longs off of this level here. Reason being is that, of course, it's the consolidation lows of this balance from back here. It's also the perfect gap fill reversal from that gap up. What day was that? That was back on just a bit before Thanksgiving, right? November 25th, gap up. Perfect reversal off of that prior high. Once again, that's 595.25. Not seeing any signs on the daily time frame chart of stronger sellers really getting involved in this time frame. Let's go ahead and drop it down to the hourly time frame chart. Let's get even more granular here. And once again, what I was talking about briefly on the daily was that because we opened near the high of the Tuesday session, these sellers were sort of underwater, right? But there was still the opportunity, the threat existed for a lower high underneath the 2-day breakdown point that opened the downside on Monday, right? So what I meant by that was that opening here could have yielded this opportunity for the sellers. And once again, if we just carefully ask the question, did sellers step up around 606.50, 607? The answer is absolutely not. You did a little bit of a stutter step there in the first hourly bar, but there's not enough to even suggest a rotation back down to the opening print, and certainly the consolidation into the afternoon is well above that 607 level. So to me, this is now just a balance range. Any higher lows here are certainly playable back to the top end. Any consolidation in here is ideal. Looking for that Brigade bolt into the end of the week, up and over that 609 level. If we are going to see a more meaningful breakdown, I would say that the first hourly indication of that would be a lower high underneath 604.25. Right, that's really the end of day flush point from the Tuesday session and also the previous highs from back over here that you can clearly see resistance acted as support a little bit before ultimately giving way into the Tuesday close of session. So 604.25 would be your early indication short, but once again, for the daily double top to really break down, it would have to be here underneath $600.50. Let's quickly come in with the intraday anchored view apps just to point out that we are above the entire cluster. So this is the election gap up. This is the low of the post-election sort of resolution to the downside, if you will. This is the breakout bar for a brand new all-time high. This is the all-time high back over here. So we're above all the anchored view apps. And once again, notice that if we were to pull back, these will slowly creep higher over time, right? Unless PPI changes this tomorrow morning, which we will cover live here on the channel at 8 o'clock Eastern time. Come by, stop into the pre-market prep. It is always a good time. So if we can pull back and hold this, and the anchored view apps are there as well, it would be more of a reason to probably look for longs and risk reward that sets up something like this for the Thursday and Friday session. And once again, anything that clears this into blue sky territories is over 609. I quickly want to check in on the Fibonacci's coming from the bottom end of the post-election consolidation just to see what that would yield in terms of a 38.2. So yeah, look at that, 38.2, and I should have known this just because we haven't made a new all-time high, of course, but as we checked in on Saturday, this is still in quite nice alignment with that $600.50 mark. So even if this were to pull back once again on the shorter durations, if I just zoom in and we start talking about this situation once again, a breakdown lower high underneath 604.25, I would not be an aggressive short here. I think that that's the main takeaway that I'd like to impart upon you, which is just that if we do break below 604.25, there might be a scalp to the downside. And the market can always trade both directions, that's fine. But would I want to be an aggressive short, new money short at this reattempt? Probably not. Probably not. $600.50, Fibonacci 38.2, and slowly over time, some anchored view apps will slowly meet us there as well, perhaps into the end of the week, if not early next week. Really doesn't make sense risk reward wise to be short here unless there's a clean break, lower high underneath, in which case we're talking about the daily double top that we had just mentioned prior. So all set here on the SPY hourly chart. I do want to take some time to talk about the market internals. So if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What we really want to focus on is actually the inverse breadth. If you can believe it, the inverse breadth, the fact that as the market was breaking down on the Monday and Tuesday session, right? Monday, here's this pullback. Tuesday, here's the continuation. What was going on with market breadth intraday on both of those days, right? If you take a look, there was actually more volume flowing into the market on Monday, the day that kicked off the breakdown. And then on Tuesday, the question just becomes, did we have substantial volume outflows? Did we have stronger sellers getting involved? We finally changed the hourly trend to down. We make a new 2-day low. Do we have stronger sellers pouncing on the market saying, unload it all or short this thing into the ground? The answer is no. I mean, substantial outflows would have to be down here underneath negative 300 million, and we just didn't get that on that Tuesday session. Of course, if we're being honest with ourselves, during today's break back in the upward direction, we really didn't have impressive volume inflows either. So it cuts both ways. At this point, I'm not seeing stronger sellers, and because the tailwinds in the market remain, bullish daily uptrends, hourly trend flip back to up, certainly it seems to me that stronger sellers are not here, and the tailwinds in the market will continue to propel it higher, especially if we are going to continue to see that outperformance from the tech sector, which we'll talk about momentarily. In terms of the advanced decline line, it's the same concept happening here on Monday. Tuesday gets back up to the zero line as the market's breaking down. So once again, were we anywhere close to trend lower zone where the bear is really building an edge? The answer is no. Similar comment on today's rally, not really being supported by a trend higher zone advanced decline line. But what I will make note of is that the intraday index score totally aligns with what we're talking about and is actually stronger to the upside during today's rally, right? So as the market's breaking down here, it's not really the heavyweight influences of the market that are pushing it lower. Same thing happening on Tuesday. It's some of the lighter weight, more esoteric stocks in the S&P, what would you say, 493, right? Not the 500, not the Magnificent 7, but the other 493 are dragging the market lower on Monday and Tuesday. On Wednesday, today's session, being supported across the board here from the heavyweight components, fueling the rally in the upward direction. If you look at the cumulative build on Monday, it's pretty horrific, but then Tuesday, the day that gets follow through to the downside, no stronger sellers at the exchange level, more so compression than anything else. During today's rally, not being supported either. So once again, taking an objective look here, the internals do cut both ways, but for the most part, remembering back to the daily tailwinds, the hourly tailwinds in terms of trend being above all the anchored view apps, the tech relative strength, I'm not seeing any evidence based on this quick analysis here that would suggest, oh my goodness, markets should be at zero or crashing aggressively. Stronger sellers simply are not stepping up at this point. Let's take a look at the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. One of the things I do want you to carry forward here in the S&P 500 in particular is the incredible poor high that was left behind on the Friday session of last week. You'll notice that if we're taking a look at value area, here is Monday, here is Tuesday. I think that this is one of the bigger tells, right? Tuesday's value, it's overlapping to down, but it's not clean breakaway to the downside, even though you can see in this sort of L and M period extension into the sort of end of the day, there was a range expansion. Value did not move with that. So value mostly unchanged, overlapping. Point of control is slightly lower. What do we have today? Anybody who bought this pullback on Tuesday is feeling pretty darn good with value area over the entire session from Tuesday as well, back inside of the Friday value also. And remember that this will act as a target, the poor high, just meaning that the auction did not end properly on the Friday high of day from last week. So I would say at this point, any consolidation over that key level we were just talking about here in the market, that's this zone at 607 and 606.50. Anybody who's been tuning into the pre-market preps knows darn well that this equivalent is 60.90 in the ES. If we're above 60.90, if we're above 607, I mean, that's rock and roll based on exactly what we just saw here inside of the market profile, right? If we're over this, everybody's happy. You're happy from Friday. These shorts are sort of in a tough spot. Anyone who's long from down here is good to go. Anybody who's long from today is good to go as well. So once again, more bullish tailwinds from what I can tell in this market and an all-time high that's in need of repair. Let's change it up and take a look at the QQQ NASDAQ 100. And this is where we clearly have some massive relative strength. The baton has been passed ultimately. Financials and healthcare lagging, but the technology sector and obviously the NASDAQ 100 performing extremely well. One of the things you'll notice on the daily time frame chart here speaks for itself. I mean, we've just got a move right to brand new all-time highs. Today was like a freight train in the NASDAQ off the open. It was nonstop in the upward direction. What we'll also point out here, and I didn't spend too much time talking about this over on the S&P, is that this prior gap has not closed in the NASDAQ 100 versus if I take a look at the S&P real quick and we just zoom back in over here, there was a little unfilled gap that closed on the Monday session, and Tuesday we were underneath that gap. So once again, on a relative basis, the NASDAQ is actually even stronger than the S&P, staying over that gap, not allowing it to close, which once again, let's think about what that indicates. If we had stronger sellers in the market, what should have happened? This is thin structure. There's not a lot going on there in terms of support. The market should have seen a rotation to retest this prior pivot high, close the gap, test 514.85, 517.15. It simply didn't happen. So stronger sellers are not getting involved in the NASDAQ. And at this point, with the new breakout to all-time highs, we can afford another higher low pullback. So either straight up continuation to the upper edge of the weekly expected move at 534.11. I believe, we don't have any upper moves measured from the weekly chart above that. So that is what we're aiming at there. And if we get consolidation, anything that's over the multi-day highs here from Friday and Monday of this week, that's 526.50. This also works for the daily chart to remain in the upward direction. Not really seeing any issues out of this particular chart. As we drop it on down to the hourly time frame, we can start to get granular. And one of the things I do want to call out is that we've repaired the extended hours all-time high. This was set on the Sunday overnight headed into Monday's session, and we've just blown right through that. So like the ES, for example, still has that poor high. The NASDAQ doesn't have anything to be aiming at because ultimately we've just breached it. So that, of course, is bullish, right? Repairing that is bullish. Now that we're above it, we certainly could use this as, once again, a higher low pullback zone, call it an inverted head and shoulders, left, head, right, something along those lines. I would want to be a pullback buyer around 526.50 and not so much a new money short. There's really not a gap here. I know it looks deceiving. There's not a gap, but I would carry forward this level. Basically, today's opening print at 525.25. If we fall more firmly underneath that with a lower high, I might start to expect some range rotation to at least come in and attempt to close the gap. At that point, I would really be open to looking for a weekly higher low, and we know that to form a weekly higher low, ultimately, we do need some sort of daily downtrend. This could possibly kick that off, but once again, this is speculation here. This is not really a concrete trade that's on the table as of right now. Primary thesis should be consolidation and continuation, looking for a higher low here, as we just mentioned. And this is, this starts to become a trade, but I would even offer the idea that if this does start to unfold, let's say here, this is a trade from A to B, and then when we get to point B, if we could support over this level at 521.85, not to split hairs and get too granular, but I mean, goodness, is that not still technically a higher low in the overall trend count? Of course it is. Of course it is, right? Put yourself in the shoes of a seller here this morning. This is always a powerful exercise to do. If you're a seller and you saw this, right, you have left, head, right shoulder, you break down through the neckline, your objective as of this morning's open should have been to stay under the neckline and look for the gap to close. That further retracement into the daily higher low at 514.85 simply did not happen. So once again, just as an exercise of gauging the types of participants we have in the market, do we have stronger sellers? The answer continues to be absolutely not. Let's take a look at the intraday anchored view app, see if we can learn anything from this. All of them providing decent support where we need them to. Generally speaking, this is going to be the most interesting one in my opinion, possibly providing super support at 526.50. The all-time high anchored view app, previous all-time high anchored view app, could be a beautiful pullback long into blue sky territories once again, and this builds the case here for that 521.85 that we were just talking about. If we come in with the Fibonacci's, because this did produce a brand new all-time high today, up to the most recent high, the 38.2 is still stacked in here nicely, so I would make that argument once again from a weekly perspective. It's still okay if this market pulls back and does something like this. Yes, there will be more shortable opportunities on an hourly trend reversal, on the possibility of a daily trend reversal in there, but from the weekly perspective, and I get it, this is not the weekend update, this is not the Saturday video, but from the weekly perspective, I would still entertain this as a higher low zone. That's the gap close at 517.15 and the 514.85 level coming from the previous pivot top back over here. So with that, let's go ahead and jump on over to the NASDAQ internals, and we'll do that on this screen right here. And what do we see? You're going to get stronger internals here on today's session, noting that the tech sector really led the market rally in the upward direction. On the breakdown from, again, Monday and Tuesday, you're not seeing volume outflows, at least not substantial on Tuesday either. You're not in trend lower zone on Monday or Tuesday. And here on the cumulative build, you're actually not getting substantial reads. Recall that substantial reads out of the cumulative tick on the NASDAQ in particular are 6,000. 5,000 on the S&P, the NYSE really, and then on the NASDAQ, it's 6,000 plus or minus. And once again, in the effort or for the sake of transparency and just being congruent in the analysis, I'm also not pounding the table that this is like the strongest rally I've ever seen. We did not have strong volume inflows on today's session. We were not in trend higher zone, and the cumulative build really wasn't all that strong on today's session. So, it cuts both ways, as we've mentioned a number of times so far, but given that the trend is up, I would not be trying to step in front of a moving freight train here. It doesn't make sense to try to short this near all-time highs. There's plenty of time. Trust me, there will be plenty of time for shorts to unfold if something like this starts to emerge. If you get this lower high underneath 514.85, if the daily trend flips to down, if the weekly trend flips to down, there will be plenty of time for shorts. But until that actually happens, I think the name of the game, it's been this way for a while, is simply pull back longs in the two big indices right now. Let's go ahead and jump on over to the market profile. I guess we've got to refresh some data on this page. Let's jump on into the NASDAQ side and see what's going on with this. So once again, if I just zoom, I can zoom in a little bit more. This was that overnight all-time high that I was saying was repaired. That is the proper move, or that's the proper thing that should happen. You've got more of a value area risk on today's session, where if you were to break underneath about 21,680 in the NASDAQ futures, if this value area is going to become top heavy and cause a little bit of a move back into these, prior sessions from back here, that's where, in my view, that would seem to take place. So the previous top from back here is the key level based on the value area, just like we talked about here on the QQQ cash. The number is 526.50, right? So we're all set. That aligns. It's congruent based on the market profile as well. Let's finish up the broad market here with none other than small caps. IWM has been absolutely lackluster through this entire sort of higher low process, back to the upside in the other two indices, right? You can see here, we've been talking about this in the pre-market preps quite a bit. This balance range has led to a breakdown, and as of right now, you're continuing to get lower high acceptance underneath this zone. It's about a 50-cent range at 239.80 and 239.30. And as long as we're underneath that, I think it acts as a little bit of a reality check, if you will, for the S&P 500. Remembering that the small caps will have some degree, or it'll act as a little bit of a headwind to the S&P, more so than, of course, the QQQ NASDAQ. So understanding that, as long as the IWM is underneath this 239.80, underneath this 239.30, maybe the proper approach, right, and this is just something to continue to watch intraday, is if the small caps remain weak here at this location, and the NASDAQ suddenly has a pretty weak day, if the NASDAQ's flat to down, you probably don't want to be looking for aggressive longs in the S&P 500, regardless of how good the long setup looks like, right? You're just not really seeing the supporting evidence across the other intermarket components. So what would change that, of course, is just call this pie in the sky inverted head and shoulders, right? You have left, head, right shoulder. You could even go as far as calling it a look below and fail on the balance range. Higher low back above this zone should rotate to the top of the range, which is the all-time high at 244.46. So watching out for that, but based on today's daily close, not really looking so good. Sort of rejecting this near the highs of day, closing in the midpoint of the previous day's range. So basically bullish back above, neutral in here, bearish if it breaks down underneath Tuesday's low, which is the daily line in the sand for that higher low at 236. Under that, we know that this is a drop thin structure. This is a rally thin structure. Let's take a look on the hourly chart so we can see this. Right? What goes straight down can come straight up, can probably come straight back down. So on the hourly chart, you really need to see this act as a double bottom. Here's your neckline sloppily, but you get the idea. This is what saves the day for the bulls across the broad market. This is what keeps things just kind of neutral and hovering around, really reliant more so on the continued tech rotation. And if we break underneath 236, that's where things get even more difficult, and you're going to need a far overpowering tech rotation to keep the S&P flat to up, right? If the NASDAQ is neutral on a breakdown below that 236, as we've just said, that's where things get a little bit harder. And once again, the target should be on that move down towards 230.25. A little bit of respect here to 232.75, but not much. Really, really not much. Let's take a look at the intraday anchored view apps for the Russell side, and you'll just, the staggering difference is clear. You've got two anchored view apps above, two below, pinching. So once again, neutral makes sense in here. This totally aligns with what we were just talking about in terms of the indications and ideas. You've got the key levels. Let's move on over to the Russell internals. Keep the show on the road, and then we'll jump into the sectors, of course, afterwards. So Russell volume flows this week, mildly up as the market's kind of flat to sideways down here. Or what, flat to sideways? That's the same thing, flat to down. As we're looking at the advanced decline line, similar. You've got a little bit in the positive territory, a little bit in the negative territory, back and forth, back and forth. So once again, it's not that it's doom and gloom Russell, oh my goodness, small caps are going to zero. It's just not really getting in gear over the key level that we need it to. And of course, in the RTY futures, that's going to be here at 24.20. Let's jump on over to the Russell side of the market profile. No data refresh this time. Thank you, Tradeovate. Let's see what else we can learn here. Where is value progressing this week? So generally, relative to the balance range breakdown, it's actually lower, right? You can see value is lower here. Point of control is slammed to the low of day. Tuesday, value is lower. Point of control breakaway completely outside of Monday. Today, value is inside of the Tuesday session, point of control inside. So you're getting much more of that bearish consolidation in my view, rather than an attempt for buyers to really step up here and try to send prices back into the range. I'd very much so welcome this. Don't get me wrong. I'd love to see that take place to keep the rotation on in the S&P 500, but the evidence, it's not quite there. Things are much more neutral in between this zone as we've mentioned so far. All right, let's jump into the sectors and see what's going on from a weekly performance perspective. The top dog is none other than the XLC communication sector, up 1.12%, followed by discretionary. At the bottom end of the barrel, it's utilities, the materials sector, the bonds, TLT, the 20-year, and then real estate, if we want to jump in there for a third pure play sector. If you wanted to come from the top down to the bottom to get the next least laggard, if you will, if that makes any sense, it's going to be semiconductors and the tech sector, which as we know makes pretty decent sense, remembering what's going on here in the QQQ with the rally. So the posture, it's really not that bad. I mean, as the S&P is sitting here near all-time highs, we're not being led by utilities, we're not being led by consumer staples, we're being led by communications and discretionary, which as we know are definitely more so risk-on sectors. Discretionary is actually now the third heaviest weight sector, just behind financial. So it's kind of interesting how that overpowering has taken place, obviously thanks to Amazon and Tesla. Anyways, communications, nice move to brand new all-time highs. Anything bearish to say about this chart? The answer is no. We can do a speed round through the sectors today. XLY, anything bearish to say about this chart? The answer is no. Gobbled up the upper wick of the bearish inverted hammer from the day prior. Really no concerns. It can afford a higher low pullback. If it does pull back, that's fine. Understand these charts are in search of a higher low if that's the case. Utilities, moving to the bottom end of the barrel, just like that. Literally moving to the bottom end of the range here. Because it's D for defensive, because it's such a lightweight sector, I'm not overly concerned, but just understand that this, of course, plays into the breadth narrative that we were talking about in the introduction. As we start to look at other, sectors that maybe aren't performing as well, keep that in the back of your mind. So, does this all turn into overhead supply when and if the breakdown underneath 77.45 takes place? Absolutely. Are we there yet? Not really. Not really. It is a wall-to-wall move as well. So just, applying some technical analysis here, generally after a 100% retracement, it's typically pretty rare that you just smash right through the equal low. You would typically need to see a lower high and then an equal low breakdown would be what brings you lower. So that does mean a counter trend move seems reasonable out of utilities, and if we get maybe a little bit of a breadth uptick into the end of the week, that would be noteworthy. If we look at materials, it's going to be a similar story here, breaking down to the equal low, if not slightly through it. Wouldn't be surprised to see a counter trend move at least attempted, but as of right now, not holding my breath. The beauty about this is that, as we know, materials is literally the lightest weight sector in the S&P 500. So this could do this, and generally speaking, as long as tech is continuing to see bullish inflows, bullish, buyers stepping up and there's a supported bid there, XLB is not going to move the needle in the S&P 500, right? So upward pressure helps, but this is not going to make or break us. As we move into the bonds, I do just want to point out here that on the CPI print, we've got sort of this interesting fundamental take here coming up in just a moment. CPI comes in at the expectations, which at first glance is like, hurrah, great. Market's not surprised by the print. But on second glance and digging deeper, and again, we'll get into this, I mean, a 3.3 on the year-over-year core inflation rate? It's not even close to the Fed's target of 2%, so I'm not surprised to see bonds coming in here a little bit, obviously, sort of pushing interest rates higher with the expectation that, right, Jerome Powell should keep things higher for longer, although it looks like, politically motivated or not, it looks like that cut's coming regardless of what the market sort of suggests with the bonds and rates relationship as of right now. We'll get to it in just a moment. Real estate, another extremely lightweight sector. If it breaks down, it's not going to be the end of the world, but we will make note that, of course, underneath 4270 is a little bit more bearish, 100% round trip. Once again, it would seem reasonable that a small counter trend move could unfold before attempting the breakdown. Next up is the healthcare sector, the now fourth heaviest weight sector in the S&P 500. Losing some ground here, but concept remains almost identical to everything else we've talked about. 100% retracement, even if it comes into 140.80, I would expect a counter trend move here and maybe another lower high or something like that, set up some sort of breakdown through some equal lows after that sort of relief, if you will. But generally, this is going to act as a little bit more of a headwind. This is not a lightweight sector. As we just mentioned, it's the fourth heaviest weight. So definitely worth paying attention to the XLV. And I'm probably actually, let's do this together here on the show. Let's go at or below. If we crack that, I want an alert to go off at 140.50 roughly, just to give me a heads up that, hey, maybe things actually pull back a bit deeper in the S&P if the tech sector is not pulling its weight. Let's move along to energy. A lot of talk from OPEC today on demand globally, sort of drying up, for the lack of a better term. And one thing that comes to mind here is just that global recession possibly could take place. But I mean, if you think about what just happened last week with the GDP revisions from the Atlanta Fed, I mean, GDP was revised literally to the inflation rate at 3.3. Right? A 3.3 GDP is not going to trigger a U.S. recession anytime soon. So even if global demand for oil, again, this is sort of news coming out of OPEC, of course, even if it's moving towards 6-month lows, the U.S. recession is just nowhere to be found. If you look at something like the XLY, which is discretionary spend, does this represent a U.S. recession? Absolutely not. People wonder about the state of the consumer. Just look at the chart. People are still spending money, clearly, based on what's going on over here. Let's take a look at industrials. Industrials still about 8% of that S&P, even after some of the rebalancing in there. Double top, yes. Gap closes the threat. Can it find a higher low from a weekly perspective here? Yes. Just be mindful that if it does close the gap, it's probably downward pressure into the S&P. So really watching healthcare, industrials, and the third trifecta of the trifecta to watch, at least from a threat perspective, is none other than the XLF. Financials, they ideally would have supported here for a higher low over the top end of this consolidation. Didn't quite get that. The only saving grace is that this looked underneath 49.60, and now we have an inside hammer from today's session. So if this happens like this, I mean, hallelujah, you're just getting a beautiful market rotation that's going to keep the S&P 500 afloat. So if the tech sector breaks down tomorrow, then what you've got to rely on is that financials catch a bid up and over the previous all-time high shelf here at 50.10. And this has been the story of the last maybe 2 weeks in the marketplace, right? It's technology versus financials. Financials carried the burden for a while back over here, and as this financial pullback has been taking place, the XLK has stepped right up and swooped in. It's the original old guards of technology. I mean, you're talking about Apple, you're talking about Microsoft, Amazon, Google, Meta, the old FB. Anybody remember, like, reminisce on the glory days of trading ticker symbol FB for Facebook, right? So, I mean, these names have really performed quite well as this XLF pullback has been taking place. And that rotation is what's keeping, of course, your S&P 500 hovering right at record highs, regardless of what's going on with the breadth that we cited in the introduction. As we move on over to consumer staples, this is a D for defensive sector. It's a little bit more lightweight. It's literally in the midpoint of its established range right here. You could even divide this into thirds and say it's straddling the upper and middle third, right? It looks a little bit more heavy here, starting to break down, not really finding acceptance over this previous pivot top, 82.55. So perhaps a gap close, hold of the 50 SMA. Consolidation in here is really just the midpoint. I would not be overly concerned with this chart when really, as and if all of the sectors start flipping into daily downtrends, I would call this neutral as of right now. As and if we start getting big, complete sector downtrends, that's when the market's going to have like this Armageddon. Oh my God, I can't believe we're down 4% in a day in the S&P 500. We're just not there yet. And it's been that way for, weeks and weeks and weeks, if not months at this point. The XLK technology sector really speaks for itself. Higher low, brand new all-time highs over the previous all-time high. Great close today, back over that level as well, 238. Any consolidation above keeps the rotation on, and we're looking for upside. If it pulls back, this is still okay as well. I'd be more concerned about the technology sector if it's under 234. That would be the top watch there. Then finally, for the sectors, it's not really a sector, it's a subsector, an industry, if you will. Semiconductors for technology. This is where we continue to cite. Remember, we talked about on Saturday, laggard sort of relative strength trend score dropping from 10 to 0. Usually does not represent good things happening in the S&P over the next 6 months. Pair that with the poor breadth we've cited in the intro from today. I mean, the bear case is... here's the deal. I wouldn't try to pick all-time highs, right? That's the bottom line. And if you've been around the channel for any period of time, you basically know that. So yes, you're starting to see some weakness out of the SMH. Yes, it can't really, resolve this range cleanly. It can't make up its mind. It's really not trending anywhere in here. Is it enough for me to go out and start shorting the S&P hand over fist? Absolutely not. Just not even close. If this can continue to consolidate over the 200 SMA, maybe it builds out a new balance. Maybe we really should start respecting it as this range back here, and we'll learn something when it's either under the 200 SMA breaking down through this thin structure, violating the trend, massive overhead supply, or if we're just in here, it's just going to be a non-issue for the S&P. And one of the arguments to make is just as long as the old guard continues to step up and do their job, we're talking about the original FANG companies, right? As long as that's happening, then so be it, right? Semiconductors and NVIDIA, the new kid on the block, is not going to take down the ship. Let's take a look at the sector ratios, see what's going on from that perspective here. If you're not familiar with this dashboard or grid, check out the video tutorial in the top right-hand corner. The XLK, it's honestly not performing as well as I would have thought relative to the S&P 500 with the break to new record highs. Yes, it's pulled back, but it would have been best if this actually developed more of a trend in the upward direction. I'd really argue it's more so sideways than anything else. So what's the saving grace? It's the fact that financials look okay here over an upward sloping 50 SMA. Consumer discretionary is just absolutely on a tear. Healthcare is not a threat to risk off. Communications is more risk on and looking good here. Industrials, not really the greatest. And then we're also not seeing a risk-off rotation with massive outperformance from staples and utilities. So it still looks like a risk-on market, regardless of this breadth contraction that we've cited in the intro with those stats. Here are the specialized ratios. I've done a little addition with this text to hopefully make it a little bit more clear as to what we're looking at. But what are all of these doing? What do they have in common? Uptrend, 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 uptrend. What does that mean? We are in a risk-on environment. We heard a little bit on, I believe it was Tuesday, about China issuing some more stimulus or starting to loosen monetary policy basically to spur more growth. They're having some GDP concerns, of course, so keeping an eye on the EEM, or you could use the FXI if you want to be more specific to China individually, right? That was this pop open here, seems to have faded off a little bit, so continuing to struggle. And I think that the closest or most important thing to tie this back to is the conversation over on energy. You could talk about global recession, but when you say global, you might have to actually just exclude the US, right? It's not happening here. GDP at 3.3, good luck. It's not going to happen. Let's take a look at the Dixie, which of course is the dollar. This is where we can start to get into that fundamental push and pull tug of war, if you will. Just noting that the dollar is technically rallying higher on today's session with the CPI print that's in line with expectations, but of course well above the Fed's target and starting to suggest actually that progress on inflation has stalled. I mean, we've really bottomed out at around 3% core and then 2.5% on the non-core. As we take a look at, let's move on over to gold. Are we seeing a flight to safety over in gold yet? I mean, a little bit of a rally here. And again, that makes sense with the inflation print coming in the way it was. But if you look at the relative move of gold to the S&P 500, it hasn't even taken out this high, never mind this high. So could it be the beginning of a double bottom and get interesting and start to accelerate here depending on some Fed commentary next Wednesday? It's possible. It's absolutely possible, and we will cover that event live. We'll cover the FOMC live 2 p.m. on December 18th. So we'll keep tabs on this. But for now, I think the main takeaway that I want you to leave with is just that the market's not really suggesting a gold flight to safety or, oh my goodness, inflation is going to wipe everybody out and a recession is underway. As we take a look at interest rates, it's a similar comment here, just noting that rates went higher. We talked about it with the TLT already and the move that we saw to the downside over there. So this all just ties back to what happened with the CPI print this morning. And speaking of that, let's take a look over at the Fed tracker tool, which is this tab here. This is where I start to scratch my head a little bit and say, why is the Fed apparently ready to cut rates aggressively based on the Fed funds futures, pricing in 98.6% odds of a 25 basis point cut to total 100 basis points worth of cuts in 2024 when CPI inflation is not at their target yet? And I would argue that if you look at, let's just open this up, the unemployment claims, right? Little uptick last week, but generally speaking, last week was the full labor report. We can check that out as well. Just for a quick reminder, if you look at the NFP, I mean, the NFP had a strong rebound. Let's zoom in on this over here. Strong rebound after, as we know, some weather-related events happening over here, beating the expectation. And the unemployment rate, small uptick to a 4.2, but if you recall from all the times we've checked in on the Fed's updated SEP, Summary of Economic Projections, this is well within their bounds. Well within their bounds. So I would tend to think that they would want to be a little bit more harsh on their stance with inflation. And as you can see, the CPI prints happening here. If I do something like this, we don't need that, but we do want these reads right here. I mean, uptick on the non-core, as we can see, that's not really in alignment with supportive, big support, I should say, of a big rate cut at the next meeting. It's just a little bit of a mind scratcher, right? I think that the higher for longer, I think Jerome, here's the deal. And I know I've said that now a couple of times. Here's the deal. Maybe that's my new quote of the day. But you've got Jerome Powell. If he issues a 25 basis point rate cut, he's got to come out about as hawkish as it gets in the actual press conference. He's got to bring out the talons and say something like, oh my goodness, yeah, I mean, a number of committee participants wanted to cut rates, so we did it, right? He basically has to put the burden on the rest of the committee. He has to make it seem like he is a hawk. He has to talk about, well, we're not really making inflation progress the way we thought we would, or it's going to be a very long and slow process to get back to 2% inflation. These are the things he needs to say in the press conference. Otherwise, I don't see a world in which inflation actually makes it back down to that 2% target if they're cutting rates in the face of inflation actually seeing an uptick. If you take a look at how it's mapped over the last couple of months, of course, you can see the uptick in blue, mild downtick here, but relative to this previous low, certainly an uptick on the core. The core is the yellow or orange line here on the screen, of course. And if you take a look at what's contributing to this inflation, a big shout out to Michael. Michael is always very generous over on X, posting his charts here, so I would encourage you to follow Michael. But looking at these selected items, I mean, it's all about insurance, and it's all about primary rent of residence, right? And these have been the themes that Jerome Powell has sort of shrugged off as, air quotes, the famous term, transitory, right? They're annual costs that will get passed through, and then things will settle down. Well, even as I continue to look down the list, electricity is still pretty elevated, and I get it that's volatile, food and energy. Sporting events doesn't matter so much. Personal care services, we know that it's services inflation, that's still elevated. Where is it? Childcare, like all of these things to me are still not yet in a place, right? No, where does the 2% threshold really step in? It's right here. Right, 2.1. We'll round down there on that one. So I don't see it. I just don't see it. And again, this one just for some jokes here. If you throw eggs into the mix, 1-year egg inflation is up around 37.5%. 37.5%. Thank you, Michael, for the jokes on this lovely Wednesday session. But there is your CPI breakdown, basically, and we're just not really seeing the progress in my mind that justifies the Fed coming in here and cutting rates without some sort of hawkish commentary to back that up. As we think about the earnings calendar, GameStop popcorn came out yesterday. Adobe after the close today, as I checked last, Adobe's actually down big time, possibly putting some pressure on markets. Remember that Adobe is related more so to the AI trade. AVGO, Broadcom, is interesting on Thursday after the close. And of course, as we go into the weekend, that'll likely finish up the heavy hitters for our cycle, and then we'll move into the next one as we approach the new year, of course. So with that, we'll jump back on over to the platform. We'll finish up our risk on versus off indications. TLT ratio to the S&P is not seeing an uptick. You are not getting a flight to safety, which makes sense. Bonds relative to themselves, small uptick, finding a little bit of a higher low floor at these 50 SMAs. This makes sense given the hot inflation read and just the expectation, or at least the bond market is probably more wise than the Fed tracker tool, saying, no, short-term yields are probably going to remain elevated as Powell has to deal with this. And the bond market might have to do the work of Jerome Powell ultimately. We shall see. We'll see what the commentary is next Wednesday. Credit spreads still continuing to move in the downward direction, indicative of volatility contraction, although there's something sneaky happening there. I'll show you in just a moment. Junk bonds, as we talked about in the introduction, are divergent to the S&P 500, moving in the upward direction. So this would be a small data point for the bears out there. If we take a look at Bitcoin in terms of a risk on versus risk off indication, got pretty close to triggering the Saylor shift ratio down here, which, by the way, it is available on the site if you're interested in trading Bitcoin. It is one of the better indications. It compares the rate of change in gold to Bitcoin, of course, and it does some calculations beyond that. But it did not quite trigger yet, and even if it did, I would argue that there's probably an opportunity on the daily time frame chart, if we just knock this back, for some sort of retest happening down in here, which is around 90,000, 91,000. Consolidation that persists over that looks A-okay, and this is invalidated on a daily. It's meant to be run on a weekly time frame chart. That's what the math is set to. So anyways, Bitcoin consolidation near the highs continues to look risk on. It's not dumping, it's not crashing, it's not doing anything to the point yet where I would say, okay, people are selling this, taking profit and running to cover expenses. Otherwise, this to me is supportive of consumers being just fine. Again, risk on in the market. As we look at breadth, not a shock compared to what we talked about in the intro, right? Breadth is getting pretty bad. You're seeing a downtick as the market's making an uptick down here in equities out of the moving average charts, and a small Small uptick out of new highs versus lows relative to last week, but still pretty depressed near that zero line, not even close to the comfort zone, which is closer to like 250 and above. So we'll keep tabs on that. Another easy illustration of this is the RSP equal weight. If you look at the equal weight S&P 500 index up here, you're actually underneath the previous pivot high, whereas over here, you're actually supporting above, right? So this is a big divergence worth paying attention to. Once again, it's one data point paired with the HYG maybe as the other bearish data point with some of the stats from the intro that might suggest, okay, breadth is slowing down here. But does this remind anybody of the same thing that happened basically as we were coming out of the 2022 base, right? As we were coming out of the 2022 base, it was like NVIDIA was the one stock to rule them all. It all relied on NVIDIA. The market was only moving higher because of NVIDIA. But yet what happened? The other names eventually caught up, right? So the way I'm seeing it is now there's the opposite threat. If the other names do not catch up because of the way breadth is weakening, yeah, there becomes a little bit of risk in terms of concentration in the top names. But it's not enough. Once again, it's two data points out of everything we've seen so far today that maybe says, okay, dial back expectations of like massive continuation, but at that, I'm not in the business of picking all-time highs. I'll continue to trade the pullback longs until all of the evidence net in aggregate really starts to suggest that that's a bad idea and we should start going the other way. As we take a look at the QQQE, it's the same story over here. If I just zoom in to a little bit more of the recent price action, just notice that this had pulled back all the way to test that high versus this had not quite come in and tested it, has not come in for the full test, and then also the equal weight has not made a new all-time high today. Of course, in the weighted, we did make an all-time high with the help from none other than the Magnificent Seven, the core original FANG stocks. As we look at the Dow versus the industrials and transports, or the difference between the two, pulling back here versus a more mild pullback, just be, cautious relative to that low. Same story in terms of breadth. We talked about volatility when we were looking at credit spreads. VIX continues to move to the downside here, or at least remain underneath the 15 floor, which of course is bullish for equities. The sneaky thing that I was mentioning is that the VVIX itself, though, is actually on the move back in the upward direction. So it doesn't mean hunker down and short the market into the ground. It just means be prepared for the possibility of a liquidation break, right? So if you made it to this point, let me know in the comments section by commenting something about a liquidation break. That's what the VVIX here represents to me. It simply means that as people get more and more positioned towards the equal high, if we don't really see follow through, which is maybe one of the indications from breadth, if we don't see follow through, if we see a pullback, if financials don't rotate to the upside, if we don't get that move, that's where those longs late to the party that are going to be disappointed cause the liquidation break. And to me, that's what the VVIX is starting to suggest is a possibility. Doesn't mean it needs to happen tomorrow, doesn't mean it's going to happen on Friday, but it's just one of the threats to the market currently with the VVIX moving higher. As we take a look at volatility futures, strong contango, and the one-day VIX is about as low as it's ever been, so all set from those perspectives there. Let's reset this, and we'll run through the core list of companies, and then I've got 4 trade ideas for you in today's episode. NVIDIA is up first, inside bar on today's session from the daily perspective. Daily chart maybe is starting to give off head and shoulders style look, but until it actually breaks underneath this prior pivot, I mean, the neckline's kind of a zone at this point, right? We've got 132.25, 129.50. Until you're actually underneath that, I really wouldn't be aggressive on the bear side here out of NVIDIA. I've been hesitant to call this dead money. I think I've used that term a number of times here on the channel. It's just kind of like taking a breather after, let's not forget, if I just go to a 5-year chart, this cycle from low up to the top, it was a 1,200% rally out of NVIDIA. I got an ironic comment the other day on X, someone saying NVIDIA can't just seem to get in gear up here. What do you mean it can't get in gear? It's up 1,200%. So always just do yourself a favor, zoom out a little bit on the daily chart. Again, if we're just analyzing this from a trading perspective, right, it's all about 140. All about 140. Here it is on the hourly into the end of the week. This thing has been flip-flop back and forth, inverted head and shoulders here to head and shoulders here, back to possibly inverted head and shoulders, right? So the name of the game here is higher low needs to persist over 137.25, break the neckline over 140, and I think you start to see a rotation towards the midpoint of that daily range at 146.25. I'd take it one step at a time here in NVIDIA, just noting that the daily isn't doing anything clean anymore. It's more so sideways. Microsoft is doing something clean. It's breaking out of its balance range from down here, had 3 days of consolidation, upper wick, starting to get nasty with that sort of inverted hammer on Tuesday, closed right back up towards the highs. Here it is on the hourly. And you can start to see that our balance range completely resolved in the upward direction. Notice that the afternoon consolidation is over 448, which was set from the Monday session, respected on Tuesday. So continued consolidation, over 448, looks good for rotation into 458.75. If this comes back down into range like this, just play the balance rules, right? That's a look above and fail. Under 448 with an hourly lower high sets up the rotation into 441.50. From there, I would reevaluate. Remember that the tailwinds behind us are bullish on Microsoft's daily breaking out of the balance range so long as it stays over 438. Next up, we've got Apple. Apple put in a nasty daily bar today, but it did break out to brand new highs. It did hit the measured move target of 250. If you take the bull flag from about in here, like this perspective right there, that bull flag, target hit, 250, all set. The daily bar, to me, is interesting because it does close underneath the opening print of the Tuesday session, so it seems reasonable that a pullback might take place to something like 244 or beyond. So on the hourly, we can start to see that any acceptance under 247 sets up the thin structure retracement to the breakout point, 244, and then you start to get what? Head and shoulders, right? So beyond that, if you really want the pullback, this would be a daily pullback to 236.50, which, mind you, is the retest of the massive ascending triangle that everybody and their sister's brother's mother saw, right? This is just a massive daily Brigade bolt looking for a higher low off of that level right there. So watching Apple like a hawk around these key levels we've just mentioned. Amazon, Nancy is up next. What do we have going on here? Strength right into new all-time highs, completely eating up the upper wicks of the inverted hammers. As we take a look on the hourly chart, this was starting to look a little bit double top-esque. The open on CPI back over 225.25, that's a lot of 25s, was the key. And just like Microsoft, look at the afternoon consolidation over 229.75, the all-time high here. So looking for a blue sky continuation move, if it does pull back into range, just like Microsoft, it's the same setup, basically just a different name. Look above and fail if you get something that looks like this. The stronger short, under 225.25 trades into 220, and then more likely some sort of gap close here at 214. So one step at a time, those are your key levels. Back to dailies, Google, quantum computing, Willow. Apparently they're sort of pushing forward to saying, hey, we are the supreme leaders of quantum compute. Tends to go in cycles. After doing a little bit more research, doing a little bit more digging, it tends to go in cycles. So we'll see who dethrones them next. Anyways, Google, any pullbacks here make a lot of sense. Any pullbacks here make a lot of sense. Any pullbacks here probably make sense on something that does that. So name of the game is higher lows. Consolidation up here is very straightforward. Blue sky breakouts over 191.81. If this does set up a bearish setup, it probably looks like exceeding the high of today's session on momentum, and then a big collapse that sets a lower high here. That's where I would want to be short for some sort of like exhaustion move and to try to capture and participate in some more of the pullback. The idea would be to sucker in new money longs in blue sky territories and then ruin everybody's day who bought the all-time high breakout from here, who bought the morning breakout from that individual session. And again, we're talking about maybe this is Thursday, maybe it's Friday. I don't know exactly when it's going to happen, but that is the style, that's the type of move that I would look for if there's going to be disappointed longs with poor location who then close out offering a little bit more acceleration to the pullback, the breakdown in the first place, right? So that's Google. Really don't even need the hourly chart. We can look at it, but I mean, it's straight up. Look at the consolidation here, right? So this is why I said needs to break, needs to come back into range, lower high here. That's where everybody's disappointed. Longs late to the party and new money breakout buyers in here. All right, that's 191.81. Next up, we've got Meta. Nice trade today out of Meta. This was the name of the game, breaking out of the daily bull flag. It's up and into blue sky territories. Not much to talk about other than like, okay, either a 626 hold on an hourly higher low or a Brigade bolt to continue into blue sky territories. That's 635.25. Keep it simple. If it does something that looks like this, sure, rotate to 607.75, but we are not there yet. Tesla, the one that fulfilled the prophecy, right? Intraday, if we go to a 5-minute time frame chart, where was it? It was right around in where? Right around in here. So look at this bar and look at this box that says H for high, traded to an exact top tick of 420.69, and the memes went crazy on X, of course. Anyways, the chart itself, if we just snap back to reality here and stop having so much fun, pullbacks that hold the previous all-time high continue. Pullbacks that hold the previous day's high continue over 409.50. The only time I'd be more concerned about this is if it breaks underneath this level, which is right around 397.75. Reason being, it's the open of the day we struggled, Monday, and then it's the consolidation lows of Tuesday. So all things considered, it can't really be a bear here until we either have this, which sets up left, head, right, and then we're under the neckline. I can't, it's got to set something up that gets more aggressive underneath that level to disappoint and put offsides all of these folks up here. So that's Tesla, primarily looking for pullback long still there. JP Morgan, as we know, the financial sector, is not really doing so hot on that pullback, and a lot of that is the result of the JP Morgan look above and fail, right? Look above and fail on the daily. Lower high was set here. Even that wacky intraday move on Tuesday completely rejected perfectly that 248 gap up high from way back here during the earnings cycle. So given that, I don't see how this is not ultimately over time going to make a deeper rotation towards the bottom end of the range. That's the forecasted target whenever you're dealing with a look above and fail. So continuing to be bearish here on JP Morgan. What does that mean for the XLF? What does it mean for the push and pull in the S&P 500? It just means that the tech sector really has to continue to pull its weight. Netflix, brand new record highs. Does this chart look familiar? It should. It's just like what we talked about in Microsoft. It's just like what we talked about in Amazon. Consolidation right over the prior high into the end of day. Looking for continuation. If it does this, I would not short this one. So actually maybe it's a little different than Microsoft as well as Amazon. I would not short the lower high underneath here. I would more so say, can I buy the pullback into the double bottom neckline, right? Brigade Bolt off the neckline at 924. Those are the core list of company ideas. Let's jump into the additional ideas, which are going to begin with none other, if I could type here, DDOG, DataDog. Here we have it. Daily time frame chart is interesting to begin with. You got this breakout happening here, deeper pullback. You've got an inside bar that's an indecisive doji. And the reason I'm more interested in this to the long side, as we'll see in just a second, is because the trend is up and it's also breaking out of a multi-month base at this point. This is a good pullback re-entry possibility, in my opinion, for anybody who maybe missed this very sporadic move in the upward direction. You can see here that there was some fair value found, an equilibrium traded, and then we broke again. So if we can hold this equilibrium, if this is still deemed as fair value, I would tend to think that there's a trade here that can unfold on some sort of like this is a pullback into prior resistance, acting as newfound support. Over this level, I'm pretty interested in like a higher low double bottom even. Call it something like this, right? Here's the higher low of the double bottom. Here's your neckline. That number is at 159.50. So watching for some possible upside here, then structure retracement trades into 169.50. That is the upside out of Datadog. I would not really be interested if this starts to float lower. There's too much thin structure. I wouldn't try to short it on the breakout of the big base. It could find an arbitrary higher low in there, but that's just the nature of what happens underneath 155, right? Just sort of like a no touch under that zone, in my opinion. All right, next up, SQ is a continuation move from what we talked about in the weekend video. Daily chart helps us here. Inside bar on Friday of last week kicked this off as an idea. Notice that it's holding pretty cleanly, this 94, and setting up the possible break still over 99.20. There's plenty of room to run. You don't have to be the first one in the door. You could start looking for bullish ideas that exploit risk reward along these lines over 99.20 into 107. That is SQ. Next up, we have GEV. The reason this one's interesting is because not only is there this really clean looking, you could call it a daily, weekly flag, balance range, whatever you want to call it, but also I did a little bit of extra digging on GEV, and we'll sort of show this together. If we open up the options time and sales, and this is no big secret. You guys can access this on Thinkorswim as well. Look at this. Look at this monster order. I was just flipping through some of the I was looking to see, like, is GEV even a contender when it comes to the options chain? Like, do people trade these things? And honestly, the answer is no. If you look at the options chain, it's pretty sparse in terms of volume. You never really want to be more than like 10% of the volume that's transacting. So I don't know. It's pretty light in here. Maybe a couple contracts as a swing or something like that. But if you go out to the January timeframe, you can see that monster order in here as well. About 10,000 contracts of the 300 call went through during today's session. Now, the tricky part about weird options inflows, and the reason you don't see me partnering with people like, I don't even know the names of these companies, but you know what I'm talking about. On X, they post the unusual options activity. You just don't know what it means. Does somebody own, did they buy the 300 calls at 10,000 units of it because they're short the stock at 360 or whatever this high is, and they're just hedging that? Did they buy those calls and did they unwind them in like lots of 100 as the day continued to progress? Like, you never know exactly what's going on with that options position. You don't know who's on what side of the trade, how else it might be hedged. So it's pretty tricky to say like definitively this is exactly what's going on. Nonetheless, there's some interest on the call side for some reason, and the technical pattern is kind of interesting here as well. The breakout to blue sky territories basically is 353.75. This is an interesting play as well, not to get too hung up on this GEV thing, but GE Vernova is offering, or they're going down the path of offering nuclear capacity in terms of energy production, which we know is going to be a theme for 2025. So that's enough about that one. Let's move along to PLTR. To finish it up, everybody's favorite. Retail is absolutely crushing it on this name. I hope you're long this. I mean, people were talking about getting long PLTR for a long time now, just to open this thing way up, right? We had people long way back down here after the sickness days, going through the rough trenches. I mean, what a payout it's been for anybody who's continued to hold. I think my re-entry was closer to in here once it got up in gear out of the weeklies. But anyways, what's the daily chart suggesting currently? Look at this hammer, pin bar, whatever you want to call it, doesn't matter. Previous area of resistance, now acting as support. Obviously, there's momentum behind it. This is an absolute runner. There's a lot of interest in this name. If you take a look at the hourly chart, I think that this puts in a mosquito pattern. Mosquito meaning that we have just a proboscis here, not a full forged head. But anyways, left proboscis. Right shoulder builds out over 71.15 and rallies up and over 74.50. Back up towards that all-time high. This was an exhaustion gap up. That opening print would act as your target through the thin structure retracement. 80.60. 80.60 is that number. So that is going to do it for today's episode of the Midweek Market Update. If you learned anything new or enjoyed the show, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that we will be live tomorrow morning, as we are live every morning, covering the pre-market prep, 8 o'clock Eastern time here on the show. We hope to see you there. With that said, have a green trading week, and I will see you in the next one.